when I first got into business, one of the first things I actually did, because Bianca, my partner, was an accountant, is I went and spoke to an accountant.
Hack.
Now, the challenge with that is I didn't have a lot of experience with accountants, nor an ability to gauge if they were good or poor at what they did. Now, even though Bianca was an accountant, she wasn't necessarily a small business or tax accountant. She had worked in big corporations as treasurers and doing more, I'll say, advanced things where they didn't necessarily spend time here. So she worked in some pretty serious organizations doing like CFO stuff and all the rest of it. Anyway, so the first accountant I went and spoke to, when you have those initial conversations and they're talking about structures, they were talking about, you can be a sole trader for now, and then you're going to want to be in a company, and then it's all about until you get to this point, which I think was about a certain tax threshold where it becomes more efficient to, have other things, whether it's trusts or set up PAYGs and all of that. And I was like, that's cool, right? But what I didn't realize is that this accountant was very much looking through my situation through their own bias. They were setting it up based on their goals and preferences, not mine.
But it's their system and checklist that sit behind it. It's like everybody fits into this bucket, tick the box.
Yeah, so that was a huge mistake, number one. If I could go back in time and revisit that conversation now with the questions I know to answer and what I'm trying to do, it could have been way more impactful and helpful. So when I really look at my situation with tax and my journey to understanding this system, that's where I think a lot of us end up and some of us stay for a long time, where we don't really question the advice we're getting. And even if it's good advice, is it good advice for my situation and what I'm trying to achieve? The second thing is I went and saw this accountant in August. See a problem with that at all?
Not at all. Well, you must work on some other financial system where they don't close out the financial year on the 30th of June.
Yeah, not going to lie, I didn't appreciate what end of financial year was in Australia either. Didn't really get it.
Well, you just thought it was a time where you got like cheaper goods? It's like everyone's got sales on now. This is great.
Well, it's like Easter sales. Someone made it up.
It's like Santa.
Cyber Monday, it's a new thing. It's just completely out of the...
I dig it.
Yeah, again, not taking it too seriously, I looked at that and go, well, if you're going to have impactful relationships with your accountant and do things properly, you really want to be speaking to them in potentially end of first quarter every year. So as March finishes and you head into April and May, you really want to be having conversations with your accountant then. So if there are tweaks you want to make or purchases you want to make or things you want to do to work with your advisors on your personal tax strategy, there's still time to actually make moves. And I look at that and go, that was probably a really big mistake I made, is just not appreciating what you can do in that scenario. And can I use an example just to kind of go through a few here?
No, you can't. We'll move it. No, of course you can.
So something I do at the end of Q1 every year now is we actually get a tax estimate. So we go, hey, look, we've been through 3 quarters of the year. Based on what's happened so far, what is our tax estimate? And then we look at that and make sure we've got appropriate money set aside for tax so that we can be not surprised when June 30 rolls around. We can go into the surprises I've had in the earlier years at another point, Grant. Yeah, so I think it's a really good starting point. If you've got a great relationship with the accountant, get a check in place. And if you haven't put enough aside for tax, you have got a whole quarter to save into that to be more appropriated. Or if you've put too much aside for tax, you might actually go, do you know what? I'm going to more aggressively reinvest in my business or move money into investments or something like that, which I've actually had happen as well. I had I put too much aside for tax for whatever reason across the year. And then it ended up being that I was not in that position. So all good. You can actually change that from there. The other thing I'll really look at is there's going to be years where you want to pay more tax because maybe you want borrowing power. And there's going to be years where you're going to want to look broke, absolutely broke, and you're going to want to pay less tax. So I've mentioned the story, but there was a year where basically Bianca and I elected that we wanted to buy 10 properties in a year. So we wanted to go and go to the banks and say, lend us a lot of money. And then their first question is, cool, show me you can service a lot of money.
Show me your payslips.
Yeah, so you have to go to them and say, this is how profitable I am.
Yep.
So the mistake that can be made, and I know people that have done this, right, is you're in a situation where you got a profitable company and then you go to your accountant and say, look, how can we pay less tax? He's like, buy a car, get some equipment. Let's do some of these financial engineering things to bring your tax down. But then when you go to the bank and go to borrowing, they're going to be like, you make no money.
Yeah.
So you can massively impact things. And again, just to dive into a deeper point here, I think your accountant being aware of the moves you're trying to make and the things you're trying to do so they can give appropriate advice is the role of the business owner.
Totally. It was funny. You on?
Go for it.
Yeah, it was funny you mentioned that. Literally on Friday, which was a couple of days ago, I spoke to my mortgage broker about, because I want to just accumulate, and like with the one preface that I just don't want to kill my borrowing capacity because that's going to demolish it. And he's like, great. All you need to do is just make sure that you're distributing as much cash to yourselves from the business as possible. And that I'm like, okay, cool. So that means like minimize for my personal scenario, minimize superannuation contributions to whatever is necessary. Any other expenses, etc., just reduce it down. And now I'm having a conversation with the accountant around, okay, so this is the minimum I need to sit at in order for me to achieve my goals for an accumulator for next year. And this is what I need to try and achieve. And here's how I'm thinking about doing it. What am I missing? Like, how could I actually improve on top of this?
Huge. So, I mean, we're both obviously into property, which is a lot of how this weighs out, but this can be in other areas as well. But to what you're talking about, this is not financial advice. It's just suggestions that you should speak to your accountant about and your team.
Totally.
But the amount you should consider paying yourself as a salary versus paying yourself as a dividend makes a massive difference to the amount of free cash flow you will have, because you may want to leave a property deposit. Or in my case, you might want to jack your super up.
Yep.
Like I'm intentionally doing that because I want to take advantage of some other tax things that are appropriate for my situation.
Hey, fellow business owner, if this topic and value-packed short video has resonated with you at all, and you want to dive deeper into creating wealth inside and outside your business, check out the full episode by clicking the link on your screen or in the description right now.